This is higher for longer, and whether it's 4.5 to 5 or they trim a little bit, it's higher for longer. And that's the adjustment we're going to have to make. And inflation is also going to be higher for longer.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. As investors enter 2023, all eyes remain on the Fed and how committed it will remain to its hawkish course of hiking interest rates and tightening its balance sheet. The latest data shows that the markets doubt the Fed will fulfill its plan to hike the Fed funds rate to 5%, or even higher perhaps, and then hold it there for a meaningful number of months. In short, most investors expect the Fed to pivot soon. But today's guest warns not to underestimate the Fed's resolve. Peter Boockvar, Chief Investment Officer of Bleakley Financial Group and editor of the Boock Report, sees rates as going higher for longer than the market is pricing in. Well, let's find out why. Peter, thanks so much for joining us today.
Great to be here, Adam. Thanks for having me.
Oh, it's a real pleasure. I really appreciate you joining us here at the start of the year, Peter. You're somebody I follow closely. I'm just very excited to get a sense for what you see coming ahead in 2023. Got a bunch of questions here based upon a lot of your recent publications. Real quick, though, let's just start with the normal context-setting question I like to ask you at the beginning of every one of our interviews here. What's your current assessment of the global economy and financial markets?
So let's take it in pieces. The U.S. economy continues to slow. And whether it's a recession or not, technically speaking, I think the trajectory of activity should be more of the focus. And it's really more of a game of semantics of whether it's a recession or not. And if we just looked at the both ISM numbers last week, below 50, that should tell you the direction of the U.S. economy. Then you throw in, of course, the housing industry, the auto industry. I mean, those are big chunks of overall activity. Europe is, whether it's in a recession or not, it's certainly dancing around one. I think the interesting part of the economy right now globally is what's going on with China. Not yet, because they're still, of course, dealing with COVID going through the population like wildfire, but what's to come in the next couple of months, and that is a grand reopening after 3 years of shutdowns that I think is going to be a major influence on those parts of the world, particularly Asia and parts of Europe that do a lot of business with China, is going to be a game-changing factor that I think people are going to have to enter into their calculations.
All right, let's dig on that just for a second then. How much of a game changer do you think it's going to be? China's consumer market isn't as big as ours, and presumably they've been doing a certain amount of trade going on, but yes, they've been locked down unlike any other country. I guess the question is the opening of China potentially large enough to net overcome the slowing of the global economy in the other places you mentioned?
It's a good question when you look at it in the aggregate. I'm more confident to say that anybody who does business with China is going to benefit greatly. The US doesn't do much business with China. We're not going to benefit so much. I mean, if you look at, okay, we talk about 1.4 billion people here. 17% of the global economy has basically been locked up for 3 years. The average Chinese tourist was spending $250 billion a year prior to COVID, which basically went to zero. I was reading a stat before this interview that there are 14 daily flights between China and Thailand. Pre-COVID, there were 400.
Wow.
So the amount of travel that we're going to see unleashed around the world is going to be tremendous. As I mentioned, a few $100 billion. Pre-COVID, it'll take some time to get back to that 2019 level, but you can be sure it'll eventually get there. And the Chinese consumer should be treated no different than Europeans or Americans when we want to spend money. And the Chinese consumer has also been saving a lot of money over the last couple of years because they haven't been spending it. So while they didn't get checks like we did in the US, even though there's been some voucher programs, they've been saving a lot of money. So there is a pool of capital on the part of the Chinese consumer that can be spent on a lot of different things.
Okay, let me just dig into that real quick, just because I'm interested. if they weren't getting stimulus checks from the government, and were forced to basically live at home for a prolonged period of time, how were they able to save? How are they not actually tapping savings during that time?
Well, yes, for some it was more difficult. The unemployment rate went up, but the factories still had their lights on. And outside of a lot of the disruptions in 2020, China made sure to keep these factories going and keep producing. Again, notwithstanding the disruptions mostly in 2020 and the disruptions we're going to see now until COVID works its way through the population. The services sector, yeah, there's no doubt that it's been hurt, particularly if you're in the restaurant business and local shop business in a mall, where one week you're open and the next week you're not. But for those that have been working, keep in mind in China, north of 80% of the working people there work for a private company. Everyone assumes that China is just dominated by these state sector companies, and you're not going to ever really see healthy growth again. But it's mostly the private sector that drives the Chinese economy.
Right,
and,
like Foxconn is a private company, right?
Foxconn, Alibaba, JD, Tencent, Meituan, Pinduoduo. I mean, there are a lot of them, and yes, many have embarked on job cuts over the last couple of years, as you would think in an economic downturn. But there's still a lot of people working, and they saved a lot of money.
Okay, and I'm asking these questions because I really don't know that much about the internals of China. So on the manufacturing side, you reminded me, we did hear stories of, yes, people were locked down, but a lot of these workers were locked down at the factory, right? Is it sort of realistic to think that the explosion from China unlocking is going to come from the consumer demand side, and the manufacturing might still increase some, but it's been up and running. It wasn't as compromised as a lot of the rest of the economy, so it may not have as much of a burst ahead of it.
Correct. It's going to be mostly the service side. I mean, just imagine running a small business in China. If you had a few stores, or like I mentioned earlier, restaurants, and you were mall based, or you had 3 restaurants. I mean, how do you run a business? And if you're open for a month, and then the government shuts you down for 3 weeks, and then allows you to reopen. I mean, it's been impossible without major resources to run a service-based business in China over the last couple of years. And we now hope that stress and pain is going to go away.
Okay, fascinating. I'd love to dive more into this, but net, what you're saying is look, if China does indeed reopen the way that it's planning to, it's going to stimulate, material parts of the global economy. Maybe not enough in totality to reverse the slowdown in other parts of the economy, but it's going to be a material factor. And certainly from an investing standpoint, if you can position yourself in front of the waves of that unlocking capital in China, there's probably going to be some pretty good investment opportunities there.
There's no question. I mean, when you look in Macau, and we own a few of the Macau casino stocks, the traffic went from 100% and fell by 90+% during the lockdowns. And it was always on, off, restriction here, reopen there. I mean, it just, the numbers were just awful. And this is the Las Vegas of Asia that is now going to reopen in a big way. So, I mean, that's just one example. But if you're a hotel in Paris or one in Tokyo and Bangkok that caters to leisure travel, I'd be pretty psyched for what your spring and summer are going to look like.
Okay, and just to use the Macau casinos as an example, because they're kind of almost like a pure play on, tourism from China. How badly did they get hit? Like, are they at bargain basement prices right now, or?
Well, the stocks have had a nice rally here over the last couple of months on the reopening. So they've already had a nice move, but they're still well below where they were in 2019 when we never heard we didn't know what COVID was. So I still believe that there's plenty of upside potential in these stocks, as there are for anything travel related that's going to cater to that region. Again, I mentioned the Thailand China travel. I mean, I think a third of Tokyo's foreign tourists came from China. That number essentially went to zero as of
yeah.
3 months ago. So and it's not just going to impact travel. It's going to impact oil prices. China's been spending a fraction of what they've been spending pre-COVID on crude oil. So I think that is going to be another major beneficiary of the full reopening, which we'll probably feel in Q2. So while right now, oil's gotten off the 70 level, now around 75 in WTI, I think people are going to be surprised at where oil goes, and not just going back to 100, but going to like 125 or higher.
All right. Really interesting. I'm curious, ballpark time frame on that?
Well, I mean, I think it's going to be back half of this year, because as each month goes by and COVID becomes just more of a cold in China, and there's this full reopening likely in the springtime also as they get through the flu season. I think that come spring and into the summer, you're going to see, again, the Chinese consumer that is going to be unleashed on the world.
Okay. All right. I want to stick a giant pin in this China reopening discussion, because it's a story of, I don't want to use the word boom, but it's on the bullish side of what could happen economically this year. Let's go over to the West, particularly looking here at the US, with central bank policy here. And, we're continuing to still see the central banks, Fed at the heart of it, staying the course, saying, hey, look, trust us, we're going to keep hiking here. Jerome Powell has said, I'm going to get it up to 5, and then I'm going to hold it there for a good long while to wait to see the repercussions of all the rate hikes that we've done. And only then we'll decide what to do next. James Bullard threw up a trial balloon that blew everybody's minds last week, saying, I don't know, maybe we got to go up to 7, right? So you have been following this and said, look, I think you borrowed a line from Duran Duran, hungry like the wolf, and I'll let you describe that in just a moment. But you're basically saying, look, if indeed the central banks are serious and they've got the backbone to commit to it, we have such a debt-saddled economy right now that this could result in a lot more pain than the markets are currently pricing in.
So the line from that song was straddling the line in discord and rhyme.
Yep.
Discord being the disruptions from all these rate hikes, and rhyme, the Fed trying to pull off sort of this soft landing. And that's the sort of the straddle that they're playing here. There are a couple of things. So we know that the Fed got run over by the inflation truck that they didn't see coming. And now they're trying to make up for it. But it's not just raising interest rates to a certain level that is going to sort of, in their eyes, regain their credibility. It's making sure we don't have a repeat of the 70s where inflation went up, it came back down, Fed backed off, it went up, it came back down, the Fed backed off, and then skyrocketed into the late 70s, early 80s. So that's the point of how many more rate hikes they have left. At this point, it's pretty irrelevant. I mean, they're already at 4.25, 4.5. So they go to 5, 5.25 on top of what they've already done in such a short, compressed time frame. I think a lot of the impact is already in place. It's how long do they keep rates at that level?
Right.
That I think right now is more relevant. I mean, keep in mind, if you had access to the capital markets over the last couple of years, you have been able to term out your debt. You've been able to borrow 3, 5, 10 years if you're an investment grade credit. High yield's mostly shorter term. But there are a lot of businesses out there. Now, of course, they can hedge, they can do interest rate swaps and so on. But there are a lot of businesses out there that had no choice but to borrow floating rate. And that's where the pain point, I believe, is now sort of enforcing itself in the leveraged loan market for the $1.4 trillion size of a market that is. If you did not hedge out your floating rate, you are seeing much higher interest expense. At the same time, you're probably seeing a decline in cash flows. If you're a real estate project, let's just say that 2020 Fed cuts rates to zero, cheap money, and you say, you know what, it's time, I'm going to build a multifamily project. So you get a construction loan in 2020, it's usually 3 years. It'll take you to build that property 2 to 3 years. And then when the project's done and it leases it out, you lease it up, then the bank will say, okay, we're going to convert this loan into a more conventional mortgage loan. Well, when you penciled in that loan, when you got the construction loan, it was probably 2 3/4, maybe you paid 3, depending on how much equity you put down. Well, now that that loan is coming due and it now needs to be refinanced into something more permanent, you're probably paying 8. And there are a lot of projects, depending again on the loan to value, any loan to value, 70% or more. These projects don't work out anymore. The rents are going to be eaten up by your mortgage payments, and there's not going to be much left for operating expenses and maintenance and insurance and taxes and so on. So when people debate it's going to be a soft landing or a hard landing, I think this is going to be like a death by 1,000 cuts type economy where it sort of just grinds because of this very sharp rise in interest rates in a very short period of time. Because for 15 years, we had these artificially low interest rates. So every loan that's coming due in 2023, you can be sure is coming off at an interest rate that is much lower than the terms that are being offered to that borrower in 2023. Now, if you have a good balance sheet, if you have good cash flows, you can absorb that hit. But there are a lot of businesses that don't. And that rate shock, which is what 2022 did bring, and 2023, we'll see the tail end of that, that's jarring for anybody who's got debt coming due this year and next year. Now, the sort of maturity wall for investment grade and high yield doesn't really hit until 2024, 2025. So at least for those bigger companies that have been able to borrow unsecured in the capital markets, you'll be okay for this year. But it's everybody else. It's everyone that's borrowing floating that's in trouble. And look at the individual. Well, the individual is having to deal with a 6% type mortgage rate. They're now dealing with 20% credit card rates that if they're not paying their bills off on time. So
right.
there's
and we're seeing a massive spike in revolving credit now.
Yeah, as also the savings rate is near the lowest level since 1959.
All right, so there's sort of two things that I hear you saying here. One is you're going to have kind of like a die-off of the companies that just don't have the balance sheet to deal with the re-rate of their debt here. But even if you do have a strong balance sheet to sort of survive the re-rate, your financing costs are higher. So it's going to eat into your profits, right? So one of the things that we've been hearing a lot about coming into 2023 is, all right, this is when the earnings recession is really going to manifest, right? And on the day you and I are talking right before the market opened, the CEO of Lululemon basically said, yep, we're bringing our forward guidance down. The market has punished the stock. And some people are saying, yep, okay, this is it. This is the start of the 2023 earnings recession. How much of that do you think is priced into the market versus how much is yet to be priced into the market?
So I think most of what has been priced into the market has been a rating re-rate, or I should say a valuation re-rate on everything high flying. And the 30 times sales have gone to 10 times sales. And for some names, 10 times sales down to 5 times sales. So that's, I believe, been accounting for most of the losses in the markets.
Right. Sorry to interrupt, but sounds like you're saying the multiple, the stock multiple has been adjusted so far.
And that is typically the first phase of a bear market, is you take a lot of the froth out. And we have certainly taken a lot of the froth out. The second phase, though, is typically the economic impact of Fed tightening and what that means for the economy and earnings. And I feel like we're really just beginning that. Now, earnings definitely have come down for 2023 off the very optimistic levels, but I think that they still have a lot more to go on the downside. On the top line perspective, it depends again on where you're doing business. If half your business is in Asia, and parts of Europe that may benefit from the China reopening, maybe you can offset what I will see is going to be very anemic growth in the US. If you're very US centric, I think it's going to be a more challenging environment. And then on the profit margin side, outside of the 2017 cut in the corporate income tax rate, looking out over the last 15 years, the two biggest drivers of profit margin expansion have been lowered interest expense and some levels to historical levels, and modest wage growth, modest wage gains. If you look at the profit pie, okay, of corporate America, and you divvy up the slices into different spots, and you look at the slice that goes to employees, well, 2015, 2016, it was the smallest since World War II. And ever since then, wage gains have been rising. And then you throw in COVID, and then it accelerates to the point where wage gains, you look at just year-over-year average hourly earnings, they were running double the 20-year pace leading into COVID. Now, those wage gains are now plateauing. Maybe in some areas they are going to pull in modestly. But I think overall, wage pressures relative to where they were pre-COVID, but off the highs, are going to remain pretty sticky. So profit margins, I believe, are still going to mean revert in the next couple of years. And you combine that with slowing revenue growth and possible continued re-rate on that PE multiple, which I think is upon us. You mix that up into some sort of cocktail, and it just tells me that while there are plenty of opportunities out there, the U.S. bear market's just not over yet.
Okay, yeah. And so we're talking about corporate America here. One thing on the consumer side, you talked about the low savings rate, the higher credit card debt. We'll get into sort of your outlook for a recession and what that might mean for layoffs and stuff like that in just a little bit. But just on the housing market specifically, as you said, anybody in the U.S. who's going to get a mortgage now, the rates are more than double than what they were, a little over a year ago, right? But if you look at markets like the UK and Canada, where, as I understand it, basically most people get a 5-year fixed mortgage, right? And then it re-rates after that. It becomes variable after that. A lot of people then go get another fixed rate mortgage, but it's at whatever the prevailing mortgage rates are there. And so the simple math is just 20% of the housing market is coming up for re-rate this year, right? At a much higher cost. So that can't be good for consumer purchasing.
That is correct. Residential real estate in the markets you mentioned, and you can also look at Australia and New Zealand. I mean, look at Australia. You had the Reserve Bank of Australia that conducted yield curve control and told everyone, we're going to keep interest rates low until like 2024. And what does that do? Well, it basically just encourages everyone to go out and buy a house,
right?
Because your central bank is telling you that your rate is not going to readjust until 2024. And then boom, yield curve control blows up in their face, and they're raising interest rates soon after. So there is the residential real estate in all these high-flying markets, as you mentioned, that feasted on low adjustable rates. Yeah, that is part of this death by 1,000 cuts, because keep in mind, every month that goes by, there's somebody's home mortgage that is resetting to a higher level. So we're not talking about like an event, like a Lehman blowout. We're talking about nicks here, every single month, where many have to adjust to this higher borrowing environment.
Okay, and in terms of the borrowing, I just want to clarify what we talked about earlier. There's a lot of people that are saying, well, the Fed's going to pivot and rates are going to come back down. Not a big worry in the long run. I believe from your writings and from what you've said today that you are saying, I wouldn't bet the farm on that these rates may hang out for higher for a lot longer than many people are anticipating right now.
Now, I do think that the Fed, like I said earlier, they're almost done raising interest rates. I know some of them say they still want to get to 5, but whatever at this point, they're almost done. So the question is what sort of economic slowdown, what sort of unemployment rate will they tolerate while keeping rates high for longer? Because also as part of the Fed mentality is, yes, we want to raise rates to regain our credibility, but we then don't want to quickly lose that credibility by panicking on an economic downturn, slashing interest rates, having the S&P go up, having oil go up, having a party in in the capital markets and inflation starts to rise again. They don't want that. Now, that said, I do think something around a 5% unemployment rate is going to make their knees buckle. And if inflation is running 3 to 4%, they may have some rates to cut, but they're not going to have that many rates to cut. The days of just going back to zero, I think for a while is over. And at the same time, how are they managing QT? Because while they may be stopping their interest rate increases, QT is going on in the background. And does that mean if unemployment rate goes to 5 and if long-term interest rates start to head higher because they want the Fed to keep hiking, but they're not, and all of a sudden the Fed's doing QE again, it's not as simple as the Fed's going to hike, things are going to slow, and they're going to start cutting again, and we're just going to rinse and repeat the cycles that we saw previously. This is higher for longer, and whether it's 4.5 to 5 or they trim a little bit, it's higher for longer. And that's the adjustment we're going to have to make. And inflation is also going to be higher for longer. Well off its peak, but we're not going back to 1 to 2% on a sustainable basis, not just on a few months, going back to 1 to 2 at the end of this year, maybe on a rate of change basis. On a sustainable basis, we are not going back to 1 to 2% for a while.
Okay. I've had other people say that similarly, but I'm curious, what are your reasons for that?
Okay, so let's break down inflation between services and goods. The 20 years leading into COVID, services inflation ex energy averaged about 2.8%. It was very persistent. The only reason why overall inflation settled out between 1 and 2 is because core goods prices, averaged 0. So you average them together, obviously with different weightings, and you throw in what food and energy are going to do. And that's why inflation always was between 1 and 2. So after this pullback in rental gains, after all said and done, why shouldn't services inflation just resume at least its 2.8% rate of increase? And I can argue it's going to be even higher than that because wage gains, while they're going to be off the boil, they're still going to be running higher than the 2.5% rate of change that we saw pre-COVID. Then let's take the good side. Now, technology is deflationary, but it's been deflationary since the history of time. It's not something new. When Cathie Wood tells you that, oh, it's this new technology, these disruptors are going to put us into deflation. Again, it's been deflationary since the history of time. It's nothing new. It just takes on a different form. But let's take some of the secular factors that were a suppressant on inflation. Well, it was cheap labor out of China. It was Walmart that was able to stock a lot of their shelves with cheap stuff out of China. Well, that cheap stuff you can't get anymore because labor costs are higher there. And while some companies are certainly diversifying their vendor base outside of China and into Vietnam and other places, they're still going to be much higher than where they were. So this large pool of cheap labor is just not there anymore. Let's take just-in-time inventory. Just-in-time inventory, and I believe is basically dead. And I probably have said that before here and other places. It's just-in-time shifting to just-in-case. It's keeping more stuff on the shelves. It means more working capital needs, higher prices, more frictions in delivering stuff. So I think that's another factor. And yes, we've seen, I'm going to talk about transportation prices. They skyrocketed and they've come crashing down. The question is, after they crash down, where do they settle out at in terms of rate increases from here? Because everything that's made in the world ends up on a boat, a truck, or a plane, or a railroad. So you have, at least in the container shipping market, you've had massive consolidation over the last 5 years. You've basically put a lot of pricing power within 5 companies for that. Now, on the air cargo side, you're going to bring back a lot of passenger airlines that were taken offline, so that those prices could normalize. But look, we've wiped out a lot of trucking companies. There's still a dearth of truck drivers. So I think when all said and done, a lot of the factors that drove essentially zero core goods inflation in the 25 years leading into COVID, it could be more like 1 to 2. But if you take 1 to 2 and services at 3 to 4, or even more, you're talking about a higher rate of inflation, even though it's much lower than it is now, than what we have become accustomed to in the many years leading into COVID.
Okay, great explanation. And you pretty much touched on this, but um, several of the recent guests I've had in this program who have a more of a geopolitical purview have said that the world is really it's different now, post 2022, certainly post sort of Russian invasion of Ukraine, which the trends were there beforehand, but that accelerated a lot of trends around the rest of the world to either de-dollarize or to start investing in trade with other countries more heavily so that they were less dependent upon the US. They got freaked out about how we weaponized the financial system against Russia and whatnot. And certainly things with China have become, China's been shifting into more of a competitor these days than a collaborator. And you talked about some of the transitions of supply chains and vendors and whatnot. As we friendshore and as we reshore, our supply chains to a certain amount, and hey, for sure, we're still going to keep some in China. We're still going to keep some in low-cost producers in Asia, like Vietnam. But as we friendshore and reshore, I mean, that's just going to be more expensive. That's a higher floor for cost of production, correct?
Absolutely, and you make a great point that some of these big picture capital spending decisions are based on, like you said, geopolitics and geography, rather than where am I going to get the lowest cost of production. When you look at the apparel industry, going back 100 years, there was a thriving apparel industry in New York City. And then fast forward decades, it got more expensive to make stuff in New York. And then things started to go overseas. And then it went, back in probably 30 years ago, we went to Latin America, went to Costa Rica, Honduras. And then all of a sudden they became too expensive. And then it went to Asia, and it went to Vietnam, and it went to China and other places where the US had favorable trade deals. And basically my point is that every relocation decision was solely based on price. Now, of course, you need to pay attention to politics. You're not going to, you can't open up a facility in North Korea, of course, even though you'll probably get some low-cost wages there. And you want to make sure that your employees are safe. So yeah, there is some political considerations, but it was predominantly, where can I get the lowest cost of production? And what you just highlighted is that is no longer necessarily the number one factor in where you decide to build your factory. And that the US, after, call it 1980, the invention, or late 70s, the invention of the PC. And ever since then, you've had lower prices for a PC. Well, if all of a sudden we're reshoring semiconductor production in the US, well, maybe we've seen the end of ever declining prices of a laptop.
Right, of chips, yeah, exactly.
Or desktop. Maybe we still do, but the rate of change, dramatically slows. And we're talking like big numbers here. We're talking much more expensive way of life to buy some of these things if they're made in the US relative to them making it in China or now India or Vietnam and so forth.
There was a piece that was published last month by Zoltan Pozsar, who basically was talking a lot about this, and he focused a lot on recent comments by President Xi of China when he was speaking to the Arab states, and basically saying, "Hey, we're planning on making massive investments in this relationship, and part of this was, and we want to start, basically buying oil using our own currency, which will have implications of its own." But one of the things that Zoltan concluded was, not only is a lot of what's going on here inflationary for the West for the reasons that we just talked about, but also he said that as other blocks, trade blocks start competing more aggressively with the West and with dollar-based trade, that more commodities are going to be encumbered by the East in a way where, like, the days of buying some of these commodities only in dollars may be ending, but also like the days of being able to buy however much you wanted to in dollars may be ending, because China or some of these other guys have locked up a good chunk of the supply, which is going to be inherently inflationary in itself as well.
Yeah, I mean, whereas pre this, commodities were fungible outside of sort of natural gas in the sense that the US had its own pricing of natural gas relative to the rest of the world, but everything else was fungible. And if I don't get it from this player, I'm going to get it from that player. And I think his argument, which I did read his pieces, that it's like I said, it's more regionalized and it becomes more cumbersome, and there's a lot more friction in doing business in what was historically a fungible commodity where you didn't really care where you got it from. Now you very much care where you get it from because you are transacting in a particular way by getting it from a particular region. So yeah, that is just another factor that will be why inflation, we're not going back to the la-la days of Kansas monetary fantasy land pre-COVID again for a while.
Great. And that's what I'm really trying to underscore with all this, right? So you talked about how wages are likely going to be sticky. We're talking here about how input costs are just probably going to be secularly higher than they were before. And then I'll see if I can find this chart that you had pumped out on Twitter. But it was a chart of the amount of negative yielding debt of more than 1 year globally, which was finally back to zero after having had years of, I believe trillions of negative yielding debt out there in the world. So, I think you said in your tweet, like, hey, good riddance, but we're going to have to deal with the consequences of the unwind of this epic sovereign bond bubble, basically meaning, look, cost of capital is just going to be higher going forward too. So trying to build a story of just like, it's going to be harder to make profits in the global economy, or it's going to be harder for the global economy to grow because of all this drag that wasn't there pre-COVID.
Yeah, now getting out of a negative rate world is a very good thing, but there's a transition period that we have to adjust to, because just think about, negative rate policy really started, I think it was Denmark, maybe, then Sweden, and then the ECB initiated it in June 2014. So we've had many years of the world's economic and market foundation on negative rates, zero rates, and a lot of QE. And
which is a stupid policy. I totally agree. I'm not trying to say it was a good thing.
Yeah. So that foundation obviously has now changed. And to your point about negative yielding bonds, it reached a peak of $18 trillion in late 2020, early 2021. And after a Japanese bond that matured in March 2024 went back to a zero yield, that was it. Good riddance, as I said. But it gets to the point of adjusting to this higher rate environment for a longer period of time, because we've had so many years of low rate policy just encouraging everyone to borrow. And it wasn't like interest rates sort of just creeped higher and gave us all a chance to adjust over a multi-year period. Rates went from like this to this. That's shock therapy. And that is the risk-free rate of a lot of things, a lot of investment decisions, and a lot of asset prices. The risk-free rate has inflected higher. Now, where it goes from here is going to be interesting, because we talked about when's the Fed going to be done. I think short-term interest rates in the US have probably peaked, but I'm not so confident like others are about where long end yields go. If you were just looking at US stats and see, okay, inflation's rolling over, US economy is going to go into recession, I got to buy the 10-year. Well, yeah, that makes sense, but I don't think it's going to be as easy as that, because I think how the Bank of Japan further unwinds yield curve control is going to be a big deal for longer term rates around the world. I think how the ECB handles not just more rate increases on the short end with their deposit rate, but they're about to initiate QT. Well, how does that go? I don't know, but I can't imagine it's going to go smoothly. So you could have people being right on US growth and inflation, but being wrong on where the 10-year yield goes, because at the same time, US Treasuries can be selling a lot of treasuries, a lot of bonds, because of the exploding budget deficits that we have, and that if the US economy weakens further, tax receipts are going to falter. And I can argue that the 10-year can go to 5%. But if we looked at just inflation and growth, I can argue it goes to 3%. My point is that I can't listen to someone with such confidence of where longer term rates go because we're unwinding this epic bubble. Again, I'm more confident in the short end because it's tethered to central bank policy, but
Right.
There's a lot of road to hoe here. I believe in longer term bonds around the world. As I hyperbolically say, the negative rate policy and the bond bubble it created, that's the biggest bubble in the history of financial bubbles in terms of dollars.
All right. I want to get to your market outlook for sure, but a few more questions before we get there. All right, let's see here. What I'm trying to do is sort of set the stage for what should folks expect in 2023. And what I hear you saying is, look, there's a lot of reasons to continue to see, a drag on the economy from all these issues that we're talking about. Growth slowdown, additional friction, all the things that we just mentioned here. There's one other thing I'd like to get your feedback on, which is because of the tremendous amount of stimulus, unprecedented stimulus that was pumped into the system following the pandemic, we created a lot of artificial support for the economy. We gave people, corporations and people, a lot of money, trillions, to go out and make purchases with, and we exacerbated the rate of increase of the asset bubbles in just about everything, which sort of sparked this FOMO, right? So we had things like, the stock market hitting, all-time highs, even in, still dealing with a global pandemic. We had housing up 20% from 2020 to 2021. Just crazy, right? Average housing prices. And so there's been some commentary that, what we did is we pulled a lot of future demand into that period of time. And now we have both, now we have the Fed very actively trying to destroy demand, right? At the same time, where we're now entering that period that we pulled the demand from. And so that there very well may be a pretty substantial demand drought in 2023, because again, we already pulled it into 2021, and the Fed's there trying to actually kill even more demand, by continuing to hike rates. So I'm curious on your thoughts about that.
Well, on the monetary policy side, that's according to plan. Monetary policy doesn't expand the economic pie over time. It just alters the timing of activity.
Right.
The Fed makes a deal with you and they say, okay, I'm going to cut interest rates, but you have to do something for me. Rather than saving for a down payment of 20%, I'm going to lower your monthly payment, and maybe we'll find somebody you only have to put 10% down. So that means I'm going to want you to buy that house today instead of waiting till tomorrow. And they do the same with autos, those obviously being the two most interest rate sensitive parts of the economy. So they're just, as you said, pulling forward behavior that there always ends up being some sort of hangover. We know from not just the stimulus checks now, but going back to tax rebate checks we've seen since the history of time, cash for clunkers after 0809, home buying tax credit. Whenever you have these like one-time steroid shots, it wears off. There's nothing sustainable to it. It just alters the timing of economic activity and pulls it forward. So yeah, that is another reason why we're going to have a period of time of sort of a stimulus hangover, both on the fiscal side and the monetary side. That's going to take time to adjust to. It's not going to be an event. It's a process, and it gets to my death by 1,000 cuts type of economy that I think is just going to be, a grind for a period of time.
Okay, so we've just talked about a lot of factors that essentially are going to make growth and profits lower next year, or at least they're going to be drags on it, right? And probably pretty substantial drags from what we've talked about. China aside for a second, that's why I think many people are expecting another poor year in the markets, because earnings are going to continue to grind down by this death by 1,000 cuts. And when we're talking about earnings, there's been a lot of discussion over the past quarter or two, at least on this channel, about how maybe unbelievably sanguine a lot of Wall Street analysts still are in terms of their earnings projections for 2023. I'm going to put up a tweet here that you had put up of the major analysts at the major Wall Street banks, what their predictions were for how the S&P was going to finish 2022. And they were all off, and they were all off to the upside by a fair amount. I think there was one bank that came in kind of near the 3,800-ish range. So my question to you is just like Wall Street overestimated earnings for 2022, is there a danger that they're still estimating earnings for 2023 and that we're going to have that correction in asset prices, as the market kind of wakes up to the fact that, hey, we've been too optimistic. The reality that's materializing on the ground as companies report are showing that we were wrong, and then everything's going to get pulled down.
Well, as we're basically speaking of just the S&P 500, it's going to be both on the earnings side of underestimating what I think earnings will end up being by year end, and overestimating what the right multiple should be. I mean, I still hear people saying, 17 times is the right multiple in this market. And I just don't see that's where we end up, both because I think that's still high, historically speaking, and especially in the face of this dramatic move in interest rates. But also, the pendulum doesn't just swing and when it gets extreme in one direction, just come back the other way and stop in the middle. Right. It always goes the other way. So I think a multiple of 12, 13 times is where we're going to settle out at. And you can obviously pick your EPS number where that might happen. But I think that sort of the double whammy the S&P 500 does. And I specify that because there are opportunities elsewhere where markets are cheaper, and even in US markets. So we're still talking about the tech-heavy S&P 500, that it's that double whammy of slowing growth and a falling PE multiple. But that's the reverse of what a bull market is. A bull market is steady earnings growth and an acceleration in the PE multiple. Now we're going to see what I think is steady slowing earnings growth and a reduction in the multiple. That's what makes a bear market.
Okay, great. And so we're getting to your market outlook in just a second, but sounds like what you're saying is just as analysts have been overconfident to the upside, by the time this is over, you think they're going to be overly pessimistic to the downside. We're just not close to that yet. And so that's the journey we have to go through here as this unwinds. Well,
that's sort of the third phase of the bear market, is everyone throws in the towel. Right. And no one wants to own a stock again. And as long as you still have people that want to buy the dip, as long as you have people that think, okay, once the Fed's done raising interest rates and inflation rolls over, everything's fine. That doesn't end bear markets. Bear markets end with outright disgust.
Right. And I just want to make it clear for people, you don't believe we're close to that yet. The sentiment is still too high.
Correct.
Okay. All right. Last macro question, then we'll finally get to the market outlook part. So I mentioned earlier, I wanted to get your thoughts on layoffs. And maybe, I guess big question is just obviously as companies are going through this debt by 1,000 cuts and earnings are compressing, they have to get into survival mode, right? And just start shedding people. And of course, once you start shedding people, consumers they either lose their income or they get more worried about losing their income. So you get a negative wealth effect. Perhaps at the same time as the housing market is also correcting, making people even more conservative about their spending, which shrinks consumer spending, which is 2/3 of GDP, which then places even more downward pressure on earnings because consumers aren't spending as much. So how concerned are you, or how with the lens you look through, do you think that we're going to have if we do get a recession of the type you think we might get, is it going to be accompanied with layoffs, sort of on the scale we've seen in other bad recessions like 2008 or 2001?
It will lead to higher layoffs. I don't necessarily think to that extent. And when it comes to the labor market, I think it's important to slice and dice it. You have the sector of the labor market. We know clearly now that everything tech related that had VC money thrown at them overhired. They overexpanded. They assumed a certain level of activity that would go on forever, and that obviously was a slap in the face last year that it would not. So we're seeing, of course, a lot of rationalization, we can call it, as a nice way of saying that we're seeing layoffs. But on the positive side, a lot of these jobs are skilled jobs, and people are finding new jobs rather quickly, because you also had, below all the VC funded companies, you had businesses that had a difficult time finding high quality people. Now they have more options. Then I look at the side of the labor market where you physically need to be on presence, on the presence
on
of
the premises. Yeah.
Premises. Okay, so whether that is a restaurant, whether that is someone who works at a hotel, or someone who works at a hospital, or someone who works in an industrial warehouse facility, or a truck driver, where you physically need to be on site. Well, I do think that those employees are going to have for longer more leverage. And I don't think those employers that have hired them are going to be so quick to let them go, because they know how difficult it was to get them. Right. Then, of course, you have financial services, you have the real estate industry that's going to be seeing layoffs. You're going to have probably the auto sector that's going to see layoffs. So it's going to be like here and there. And the question of where does it end up is obviously, how do you sort of bring this all together in a cumulative fashion? And I think that that's part of this process that's unwinding here, and that will continue this year and into next year, rather than, again, a housing bubble blow up sort of event, or the tech bubble bursting being an event. There's just going to be a lot of death by 1,000 cuts. But even if the unemployment rate goes to 5, that's historically very low. So it's not like times before when the unemployment rate went to 7, 8, even double digits. Now, some of that, of course, is the participation rate being more muted. But I do think that we can skirt an economic downturn without having a dramatic rise in unemployment, rather than more somewhat of a rise in unemployment.
Okay. All right. Well, that's good to hear. That is a little more sanguine than some of the guests I've had on recently. So I'm sure some people are happy to hear that.
Wait, one more point. Sorry.
Yeah.
If you're a white collar worker, you're going to have less leverage, because if I'm an employer and I need to cut costs, well, I can hire anybody around the country because of the work from home. Now, some businesses are saying, we want you in our office, and maybe that changes a bit, but the white collar worker, as opposed to the blue collar worker, the roles have been reversed now, and the white collar worker is going to have less leverage than a blue collar worker, as I said, where you physically need to be on site for your job. Yeah,
and I think probably rightly so. Blue collar workers aren't going to shed too many tears for those white collar workers. And one thing I've been saying is there's a lot of people that are cheering the work from home movement, and there's a lot of good that it's unlocking. But the thing that you have to remember is, especially in a tough economy, to your employer, working from home, a remote worker can be, you got to be careful what the definition of remote is, because once you're remote, it doesn't matter if you're remote, 2 towns away, 3 states away, or 3 countries away, right? You're competing all of a sudden with a much greater workforce, because the employer doesn't really care. If you're not in the office, then all he really cares is, value per output, right? Price per output.
I can throw out 10 job openings for one job, and all that means is I'm putting ads in 10 different states for the same job.
Right, or countries. I mean, increasingly, there's a lot more. I'll say it that the company I'm engaged with here, a lot of our IT work comes from Eastern Europe at this point in time, and I'll tell you, those guys, not only do they speak fine English, but they are, not only they're price competitive, but they're quality competitive, right? Yeah. For sure. All right. So finally, we're at the point where we get to talk about your market outlook, Peter. And I really just wanted to set that stage, because there's a lot of cross currents. Let me put it this way: there's a lot of gravity pulling things to the downside in terms of growth, but there are some cross currents. You talked about the role that China is going to play here. That's going to be, a very kind of bullish dynamic in this soup of, slowing economic growth worldwide. I'm presuming that means you're going to have to be it's been so easy the past decade, right? Where all the rising tide and everywhere rose all boats, so you could pretty much just throw a dart and ride it. I think now you're probably going to have to be a lot more intentional and specific about where you allocate capital. But don't let me put words in your mouth. How do you think the markets are going to perform next year, and how are you recommending people allocate for it?
So geographically,
our interview with Peter will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Peter for free, just go to wealthion.com/AdamsNotes. And finally, if the challenging macro outlook Peter has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Peter has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Peter Boockvar.